We are diving straight into this explainer of Illinois Tool Works, the ultimate multi-industrial compounding machine. The data is completely clear, the track record is firmly established. So let's get right into the analysis.
Illinois Tool Works, widely known by its ticker ITW, is a Fortune 300 multi-industrial manufacturing powerhouse. We're talking about a true behemoth here, with a market cap of roughly $85 billion. But what actually defines ITW isn't just its massive size. It's their proprietary operational playbook, specifically their 80-20 front-to-back process. Basically, this is a rigorous internal system where management systematically hyper-focuses their key resources on their largest, most profitable customers. That vital 20% that drives 80% of the value. By totally eliminating the friction of catering to low-margin distractions, they streamline operations entirely around their best clients. When you combine that relentless optimization with a highly decentralized entrepreneurial culture where subsidiaries run with the agility of a local business, well, you get a manufacturing giant that executes with just unbelievable precision.
And the true strength of this $85 billion giant really lies in how it slices up its revenue. It's honestly a masterclass in risk mitigation. Look at the trailing 12 months as of mid-2026. Their largest segment, automotive OEM, brings in roughly $3.32 billion, which is heavily supported by the global transition to electric vehicles. Right behind that, you've got test and measurement and electronics at $2.89 billion, followed by food equipment at $2.71 billion, and welding at $1.93 billion. Then there's the other category, bringing in $5.4 billion across highly specialized construction, polymers, and specialty products. This massive diversification across totally distinct end markets is absolutely crucial. It acts like a structural shield, basically dampening the cyclicality you'd normally expect from a heavy industrial manufacturer when the economy gets bumpy.
Now, the sheer scale of their intellectual property is what forms their wide economic moat, and it is heavily defended by an arsenal of over 21,000 patents. But the real competitive advantage here? It's the actual nature of what they manufacture. ITW produces highly engineered, specialized parts that are relatively cheap in the grand scheme of an assembly line, but absolutely mission-critical to the final product. Just think about a specialized automotive fastener or some precision welding equipment. For a car manufacturer, these parts are just a tiny fraction of the total cost of building the vehicle. But if a single specialized bolt fails, the entire manufacturing line stops and the final product is ruined. That dynamic creates massive switching costs. Customers simply will not risk swapping out a reliable, mission-critical ITW component just to save a few pennies with some unproven generic competitor.
That deep, highly defensible moat perfectly positions ITW to capitalize on three massive, long-term secular tailwinds. First up is nearshoring and reshoring. Ever since the supply chain shocks of 2020, we've seen a true manufacturing renaissance in North America, and that is a massive demand driver for ITW's welding and test and measurement segments. Second is the electric vehicle transition. Remember, automotive OEM is their biggest segment. And crucially, ITW's content per vehicle is often much higher on an EV than on a traditional gas-powered car, mainly because of lightweighting initiatives and really complex battery component requirements. And finally, labor automation. Persistent labor shortages everywhere are directly driving demand for ITW's automated commercial food equipment and highly advanced electronic testing systems.
So how does all this translate to the bottom line? Well, just look at the incredible 26.7% operating margin they achieved in the second quarter of 2026. This number right here is a literal masterclass in capital allocation. Over the last decade, unlike companies that just chase vanity top-line metrics so they can look bigger on paper, ITW management made a very deliberate, disciplined choice. They relentlessly pruned unprofitable business lines. They literally walked away from bad revenue to focus strictly on high-margin operations. Because of that, operating margins have climbed from around 20% a decade ago to this 26.7% mark today. And get this, management is explicitly targeting a 30% operating margin over the long term.
Because of their asset-light manufacturing approach and highly variable cost structure, ITW operates almost like a corporate toll booth. Historically, they routinely convert over 90 cents of every single dollar of net income directly into free cash flow. Now, even accounting for some seasonal shifts, which resulted in a still very robust 77% conversion rate in Q2 2026, this metric proves one thing. ITW isn't just generating paper accounting profits, they are generating cold, hard cash that can be immediately deployed to create tangible value for their shareholders.
And we see that elite execution reflected perfectly in their exceptionally strong Q2 2026 results. They posted $4.3 billion in revenue, which easily beat the consensus estimate of $4.19 billion, representing a 6.1% year-over-year growth. Even more impressively, GAAP earnings per share came in at $2.84, delivering a 10.1% increase year-over-year. Digging underneath those headline numbers, organic revenue actually accelerated by 4.5%, heavily led by a 6.4% surge in North America. Because of this powerful fundamental momentum, management confidently raised their full-year fiscal 2026 EPS guidance to a range of $11.35 to $11.55.
So what exactly is management doing with all that cash from this recent outperformance? They're giving it right back to shareholders. ITW recently authorized a massive $6 billion share repurchase program. To put that in perspective, that's roughly equivalent to 7% of its total market cap. And they paired that with a 7% dividend increase. Now you might glance at their balance sheet, see a seemingly high debt-to-equity ratio of 3.35x, and wonder if that's a red flag. Let me be clear, it's not. That is not a distress signal. That high ratio is simply a mathematical quirk because ITW has been so aggressively buying back shares for decades, which continuously shrinks their equity base, the denominator in that equation. Their debt is easily serviced by massive cash flows, they are backed by $839 million in cash and equivalents, and they have an incredibly strong interest coverage ratio of 14.4x.
But of course, all of that flawless execution and cash generation comes with a price tag. At roughly $293 a share, ITW carries a market cap of about $85 billion. Right now, it's trading at 26.7 times trailing earnings and roughly 25.6 times forward earnings based on current guidance. Historically speaking, ITW always commands a premium multiple relative to the broader industrial sector. It usually fluctuates in a 22 to 26 times PE band. The market willingly pays this premium because of ITW's software-like profit margins and its elite status as a dividend aristocrat. However, it is absolutely crucial to acknowledge that at 26.7 times, the stock is currently trading right at the top end, if not slightly above, its standard 5-year historical valuation band.
Breaking down the fair value estimates, based on an 8% EPS compound annual growth rate and 2.5% terminal growth, we see a base case fair value sitting right around $285 to $295 per share. The bull case pushes that up to $320, but let's be objective here. Unlocking that upside absolutely requires management to flawlessly execute and hit that aggressive 30% operating margin target we talked about earlier. Conversely, the bear case models out to $240 per share, which realistically prices in a severe global manufacturing recession that would inevitably drag down their top-line growth.
From a technical perspective, the long-term trend remains solidly bullish. We're looking at a multi-year chart of higher highs and higher lows, which is a classic footprint of consistent institutional accumulation. The current price is hovering right around $293, facing recent 52-week high resistance up at 303.16. Following their strong earnings report, buyers are actively defending the 280 to 290 zone. However, if that bear case scenario of broader market weakness actually starts to materialize, initial strong structural support lies lower at the 50-day moving average near 275. And if things get really ugly, there's a major, long-term structural floor waiting all the way down at 250.
Now, despite the premium pedigree, we have to objectively assess the risks here. While highly diversified, segments like automotive OEM and construction are fundamentally sensitive to economic cycles. A global macro slowdown will undoubtedly impact their top line. Additionally, while ITW possesses excellent pricing power, there are always timing lags. When raw materials like steel or plastics inflate rapidly, it takes time to push those price hikes through to the customers, which can temporarily compress their margins. And finally, the valuation itself is a risk. Trading near 27 times earnings leaves a very, very thin margin of error. At this premium, any execution misstep or unexpected earnings miss is going to be severely punished by the market.
But here's a really fascinating twist. The downside risk is uniquely cushioned by massive institutional ownership. Financial giants like Vanguard, BlackRock, and State Street are dominant holders of ITW. Because ITW boasts a multi-decade track record of consistent dividend hikes, it is an absolute staple in massive dividend growth ETFs like VIG and SCHD. What's so interesting here is the market mechanics of this. The constant, automated passive capital flows into these dividend ETFs create what is essentially a structural price floor. During broad market sell-offs, this blind programmatic buying acts as a shock absorber for ITW's share price.
So, pulling this all together, we arrive at the core investment thesis. I like to call it the ITW compounding formula. Look, ITW is not some hyper-growth tech stock. It is a methodical, financially engineered compounding machine. Step 1. They really only need to maintain flat to low single-digit organic revenue growth. Step 2. They relentlessly squeeze out higher margins via that internal 80-20 optimization. Step 3, they take all that massive cash they just generated and execute aggressive share count reductions. And the result is Step 4. By shrinking the share count and expanding margins, ITW systematically manufactures 9 to 12% annual earnings per share growth, even in a completely stagnant macroeconomic environment.
Based on all the data in this explainer, our final verdict right now is a hold. ITW is an elite, wide-moat business firing on absolutely all cylinders, but at current levels, it is fairly to slightly overvalued. The margin of safety for dropping a large lump sum entry in today is just too thin. So, existing investors should firmly hold and continue to reinvest that 2.17% dividend yield. For new capital, the strategy is pretty clear. Buy on dips and dollar cost average on any macro-induced pullbacks into that 265 to 275 zone. Ultimately, ITW serves perfectly as a core industrial anchor holding for any long-term dividend growth portfolio.
Which leaves us with the ultimate consideration for any high-quality asset like this. ITW offers flawless operational execution, unyielding cash flows, and a totally battle-tested moat. But you have to ask yourself, is paying a premium for perfection always worth the price?